Welcome to the Investing Mastermind Podcast. My name is Sina Lundholt.
And I'm Michelle Markey.
Today, Michelle and I want to talk about the mindset of the value investor, and we want to put it into the context of what is going on currently. Because in my opinion, and maybe you see something different, Michelle, but I'm not doing a whole lot these days in terms of investing in stocks, doing the actual action of purchasing stocks, because right now, none of my businesses, none of my wonderful businesses that I would like to purchase, some of the businesses that I've studied, none of them are at a price point where I feel comfortable buying. And at the same time, none of them are at a price point either where they're too expensive compared to the actual value of the company. So I wouldn't be in a situation where I would sell either. So for me right now, it's just about being patient, which is maybe the first topic that we want to touch upon today.
Yeah, for sure. I think it's a little bit of a tricky time for people who like to invest, like Warren Buffett, Charlie Munger, Phil Town, Guy Spear, Monish Pabrai, or Danielle Town. And I'm sure a lot of them are in a similar boat of waiting with lots of cash and biding their time until opportunities come up, because I've been looking at both some of the major stock market indices, like say the S&P 500, and that seems to be somewhat fishtailing and kind of not going anywhere fast. Like it doesn't go up or down that much. And what that signals to me is that it kind of feels like a little bit of stock market purgatory, where things are not at a fire sale price and they're not maybe as bubblicious as they once were, like they were in 2021. So even though the market has come down somewhat from its heights, it's still not that cheap. And even other indicators like the Schiller price to earnings, it hit a maximum of 40 PE at the height of the current, pandemic bubble, but then it kind of has regressed a little bit, but it's still at 30. And that's still kind of double what the historical stock market's average was. So based on that indicator, and there's more that we could talk about, like the Buffett indicator, the market is still not on sale. It's still fully valued. So it's sort of like a no man's land. So this is a great time, though, to kind of hone our skills in terms of learning and getting to know ourselves as investors and figuring out what our investment temperament really is.
Yeah, exactly. And just to touch upon some of the things you mentioned today, we won't go into detail about it, but you mentioned something like the Schiller PE, which is a great tool that investors can use to kind of see, okay, is the market overvalued, just as well as the Buffett indicator? And we could definitely talk more about that in a separate episode. But in general, the market right now seems to be still overvalued. There might be businesses out there on sale. As mentioned, there's nothing in my circle of competence right now that's on sale. Anything I've looked at that's on sale, but there definitely could be businesses out there that's trading at a great price. We want that margin of safety when we buy a stock, because in case we've made an error, in our case, we've talked about the checklist in a previous episode. And if we made any mistakes in our checklist, we want to buy at a margin of safety in case we made an error. So if we lose money, we won't lose much. But if we do, really hit a great company, we will win a lot. And that's why we're doing that business case. But we're always buying at this margin of safety. And right now, I don't see a whole lot of, at least in my circle of competences, anything interesting that's trading at a margin of safety. So these days, what you can do and what I'm doing as an investor is to study companies. It's a great time to study. It's a great time to listen to this podcast, learn about investing, maybe, take a course, read a book, in order to actually learn about this Warren Buffett style and investing. Right now is the perfect time for that. And if you listen to our episodes about checklist, you can find it in the archive. it's a great time right now to start looking into a business and reading some annual reports and get to know some companies that one day you might want to invest in case the business starts trading at a great price.
Yeah, absolutely. And you can also try to figure out how much of a margin of safety are you willing to take, because what Sina and I have been taught is that ideally you want to get a 50% margin of safety, but
Hmm.
maybe you don't have to absolutely get something at bargain basement prices like a 50% margin of safety might get you, and maybe that might not become available if the market just goes a little bit in an up and down, but not like super up and down of volatility. So if you only have little ups and downs, you might, if you're chomping at the bit to get invested, you might settle for a smaller margin of safety, like between 15 to 30%. And that might be good enough for you, or it might be the best that we might even get. Like back during the pandemic low of March 2020, the market seemed to only go down by about 35%. And to me, that was, in my opinion, back then, not good enough. So I didn't jump into too many holdings at that time because I was expecting an even bigger drop. So I somewhat regret that. And maybe in retrospect, I should have been willing to invest even with the 35% margin of safety. Let's say I'm using the market's drop of 35% as a proxy for saying that that's reflecting intrinsic value, but it may not always be. Just because like the main market index like the S&P 500 drops by 30% doesn't mean your favorite company's intrinsic value is also going down by 30%, but it could be a rough proxy. So it's just kind of a ballpark figure. It's not to say you should definitely invest when the overall market goes down by X amount. It's just something to keep your eye on, as kind of seeing how is your favorite company kind of doing compared to the index, and is it even more on sale or is it even less on sale than the overall market? It may or may not be. So things like that, I just try to keep that in perspective. And like Sina said, it's such a great time to learn to invest right now, especially if you don't have any particular companies you're super excited about to buy right now, then this is a great time. Like there's so much to still learn. Even I need to learn a lot more, and I've been able to invest since I was a teenager, but I still know like a very tiny bit of what there is to know as far as investing wisdom myself.
Yeah, exactly. I think Warren Buffett, he says that this is an area where, the older you get, the better because you become more and more knowledgeable. Something you also said here about what we learned is we needed a 50% margin of safety. I also remember reading that even Buffett didn't stick to that. He used to do that, but recently, I think it was Apple. There was a discussion if it was really trading at a margin of safety at the time. And there are many, many valuation methods out there. There's many ways to calculate the value of a company, but I just remember seeing some value investors that were discussing if Apple was really on sale, or and that also ties into Munger's thoughts about buying quality at a fair price rather than the initial strategy of Warren Buffett of buying super cheap businesses. That if you listen to one of the previous shows with Adam Mead, you would also hear us talk a little bit about this cigar butt style of investing that Buffett did in the very, very beginning.
Yeah, and it was
Um,
such a great interview with Adam Mead.
yeah,
I think we learned so much from him and his amazing book, The Complete Financial History of Berkshire Hathaway. And I don't think Sina and I can thank Adam enough for his generous time that he shared with us to come onto the show. And like he's just
absolutely.
an incredible teacher, and he's got a lot of free resources that you can check out. Like we're just giving him a little bit of a plug because he's just such a great guy and has shared a lot of Berkshire and investing knowledge with the whole world. So there's so much that we can continue all learning from each other and just help each other improve as investors.
Absolutely. I'm also really, really honored that Adam came and joined our show, being a fairly new podcast and Adam really being such a name in the value investing community. It really shows how he's paying back to the community and does such a fantastic job in sharing with beginner investors how to actually invest like Warren Buffett. So yeah, thank you so much, Adam. If you're listening, we really appreciate you being on the show. So one thing we've talked about now is that Warren Buffett and Charlie Munger are being patient when they invest. They say waiting is the most important skill. I believe it's Munger that says something like that. We've also talked about the margin of safety, which is a really, really important skill of a value investor as well. There's a lot of people out there that they don't know the difference between the stock price and the value of the company. It's actually not the same. The stock price you see when you open your app, it doesn't mean that the company is worth that number you see on that app, but you can actually calculate what the company is really worth. And then okay, am I getting a good deal here or buying something that's way overpriced? So we talked about margin of safety too. Another important trait of a value investor is to think like a business owner. We've touched upon it in the past of thinking like a business owner when investing. Do you have any tips or trick to get into that mindset?
Yeah, like if you think of yourself as a business owner, you tend to care a lot more about what you're invested in because, like, say in the early days when I was first investing, I just looked for whatever higher dividend paying companies there were. And I didn't really seriously think of myself as owning a piece of that business. All I cared about was a little bit of that cash that I would get in my brokerage in every quarter from some random dividend companies, but I didn't really think about what does it mean if I own Verizon and their internet and their TV assets? Like, what does it mean to own a piece of fiber optic cable if I had to take care of that myself? So, if you were interested in investing in, say, Verizon, whether for the dividend or because you believe it's a great company, let's say, you would have to think about, oh, if I were part of the maintenance crew and I have to go all around the neighborhood fixing up the fiber optic cable sometimes or installing the new internet and TV services for customers if you get Verizon Fios or what else does Verizon do? What is Verizon's plans for the future? Or do you think they run a good cellular business? Like, is their offer of, get a new iPhone and trade in your old one? Is that a good deal? Or what's involved with them refurbishing phones and then selling new ones? Do they actually make a good amount of money? So if you think about if you were in the shoes of the management actually running Verizon, that makes you care a lot more. And then you won't just think of Verizon as just some ticker symbol in your brokerage that you're getting dividends from, like I once did in my early 20s. But then I would think, wow, there's a lot to this business. And I have to seriously consider, do I agree with the direction that this company is going in, or do I not understand that business and maybe I shouldn't be invested in this business? So if you just flip your hat of what's really involved in running a business and what it takes to earn money and then distribute that to the shareholders, you would think differently about committing to it because anybody can buy a stock, but if you actually want to own it like as a business owner, you think of more steps ahead and you think of what's really the underlying business economics. And that's also known as the business fundamentals of what goes into the everyday operations of the company. And yeah, so you just have to look at it from some of that. And how do you think of it as being a business owner?
A term that I've heard often mentioned from Buffett and other sources in the value investing community is capital allocation. It simply means what the management chooses spending their money on, right? So, and you can say the same for you. Once you get your paycheck, what do you actually decide spending your money on? And for me, I like to invest in stock, so I really try to be frugal, think about what I'm buying, and it should be the same for management of the company. If they buy a private jet, for example, and they do it just to signal that everything is going great and we can buy a jet, then it's probably not good capital allocation. If the CEO has to travel a lot to business meetings across United States, for example, then it might be good capital allocation to actually invest in a private airplane. So it's difficult. It takes some time to really understand that, but it is so important to look into what is management actually doing with their money. Are they investing in something that will grow the company over the years instead of this instant gratification? Again, back to, the way that you also spend your money, you as the listener. And it's actually, Michelle, something I really admire with you when we talk about money or what to invest in, that you're really good at not focusing on instant gratification, but really allocating your capital for the future. When we discuss things, it's something that I've noticed and I really admire about you. And also wanting to invest your money in order to actually in the future live a better life instead of getting that cafe latte today, that instant gratification, right?
Yeah, absolutely. And I admire the similar thing about you, Sina, and how you're a business owner and you're investing for the generational wealth building for your family. And I think that's a beautiful thing. And I'm sure you're teaching your family members about what it means to invest and why this is not only a hobby to you, but how this will have benefits for everybody in your family. So I think that's a wonderful thing that we're both business owners and both like oriented toward investing for the betterment of our families and communities. And I think that it's just like a positive flywheel. So thank you so much for saying that. And like that's actually true. And when I see my friends or my friends and family members and their kids, what I like to tell the kids is I kind of like talk about there's two kinds of people. There's the people who need instant gratification right now, like they have to eat that piece of chocolate right this moment. As soon as they're given, like it was just Easter recently, and there's a bunch of chocolate eggs that the kids got, and then they can decide, do I want to eat this chocolate right now, or can they hold on for a few hours, or tomorrow, the next day, or maybe just moderate themselves, like have only one piece of candy every day. And the kinds of people who are more likely to be successful are the ones who can delay gratification. So it's a little bit of a test to do with like young kids and see can they pace themselves and not eat all the chocolate right now, but hold on to some of those Easter eggs and see if they can kind of save them. And so all these money and investing lessons can even be taught to children as young as 3 years old. Like they already understand the concept of allocating their Easter eggs, of like only eating one today and being a good child like that. So it's kind of funny.
100% agree.
Yeah, it's amazing how, we could all learn so much earlier in life. And so the sooner that we share this wealth of knowledge with people we care about, the better off we'll all be.
I absolutely agree 100%. And I can tell you that it's not something I was taught at home, all these things about delayed gratification or anything like that. Actually, previously, I was very focused on getting that instant gratification until I actually learned to wait a little bit. But it's something that I teach my children, and I'm actually quite proud of my kids because they are really, really good at it. My daughter is 9 and she's so good at saving her money. I'm super proud. And it's important for me to teach my kids because my parents didn't necessarily not teach me because, they didn't want to. They might have not known better and might not have been so focused on these topic of budgeting and being careful with your money and things like that. So I didn't learn it growing up. I simply was interested in the topic. And when I was in my early 20s, started actually to change some of the patterns that I had, and I'm really grateful about that today because yeah, I'm just in it for the long term instead of, like I say, I used to buy cafe lattes and things
Hmm.
like that, and it takes a second while building generational wealth, as we talked about, will last generations, right? So
Yeah. Right. And you know what? Like all of us, if we've had any little bit of experience selling anything, like maybe as kids, some kids might have had like a lemonade stand, or they in Warren Buffett's case, he went around his neighborhood throwing newspapers, and that earned him some money as a young child. I'm not necessarily saying kids should work, but if we've had some younger experiences in our lives, getting to understand and appreciate the value of money and what it can be used for and how to allocate it. And if we start gradually sharing this knowledge, I think a lot more people would be better off. And, instead of trends, like I've seen news of how people went back to living more paycheck to paycheck now. Like during the pandemic, when there were a lot of stimulus checks being sent out, people got to stash some money away in their savings, but now a lot of that is being spent down and people are going back to their old habits. So if you think about that, you can change your habits by becoming aware of them. And so, like
Hmm.
like we talked about earlier in the show, getting to know yourself as an investor and how you manage your money is so key, because it can mean the difference of, when you are ready to invest. There's always that saying that like there's like some rule in investing that as soon as you invest your money, the stock is going to go down, and you're going to
Yeah.
be like, darn it, I should have waited until it went down even more. But then you might never invest if you have to keep waiting. So, but that's a good time to test your mettle, like test your inner resolve and how much conviction you have in something. Because if you start sweating the moment something drops by a few percentage points, then maybe you didn't do your homework enough. Maybe you need to go back to the drawing board and study even more, because if you are truly willing to commit to a stock, you're not going to care if it goes up and down by like 20% or even 50%. Like if you've done your homework, a 50% drop in the stock you invested in is not going to phase you. So we have to build toward that level of, when you're a beginner investor, it's hard not to feel emotional,
Mm,
because you're like, oh my
yeah.
God, I invested at $10, it went down to $5. Like, what did I do? But you just have to stay calm and try to remember what was your investment case, and also work on the opposite. Like, what is the case to not invest in something? So if you've built up those cases, kind of like if you were a lawyer, you have to know what the opposition is going to say and try to present your case to the judge. So if you think about it like that, that can help you be a better investor also, that you're prepared no matter what might happen to the company or the stock. You know what you're getting into, and you freak out less. Like, it's not to say you stop freaking out, because it's very hard for us as human beings to not get a little bit emotional sometimes, but you can condition yourself to cope with it better. And that's what investing kind of helps with too. It helps you cope with some of life's challenges, not all the challenges, but some of them. So yeah.
Yeah, that's another good trait you actually just mentioned, being the devil's advocate, looking at it from another angle. And also, as well as, what you talked about when the market is going down and you just bought, taking a deep breath, keeping cool. And like you say, it's something that you can condition, like today when the stock is going down. It's exciting. I'm excited because then I can buy more at an even better price. But with the first time you do it, it is super uncomfortable. On that high point, it's time to end the show. Do you have anything towards the end here that you want to say just before we end the show?
Well, all I'm going to say is just keep hope and faith, because if you've been waiting in cash like I have, like, you hope that there will be light at the end of the tunnel. And
Yeah.
until then, I just keep studying. Like, I have so many investor letters and books to read that there's never enough to, run out of. Like, there are so many materials that I still need to learn. So I'm
Yeah.
staying totally occupied, even if I can't buy any stocks that much right now. I mean, I bought a little bit, but not all that much. So I'm mostly waiting for my chance. But yeah, that's what I'm doing. What are you
Perfect
doing?
time to study. 100%
Hmm.
agree.
Yeah.
Great. Well, that was it for today. We will be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.